Hey everyone, welcome back to Corporate Decoder, the place where we sift through the fine print so you don't have to. Today we're cracking open the PIMCO Flexible Credit Income Fund's latest prospectus supplement, and trust me, it's juicier than it sounds. We're talking hidden fees, strategic shifts, and maybe, just maybe, a few reasons why your investment portfolio might feel like it's stuck in reverse. This prospectus supplement from early April updates the original from the end of October last year. So what's new, what's changed? We are here to give you the TLDR of it all. First off, let's remind ourselves what this is all about. The PIMCO Flexible Credit Income Fund is like a mutual fund, but with a twist. It's closed-end and an interval fund, meaning they're not constantly issuing new shares, and they offer to buy back a limited portion of your shares at certain intervals. That means there is less liquidity than you may be used to in your typical fund. Their goal: to give investors some attractive returns while also generating income. It does this by diving into the world of credit, from corporate debt to mortgages, and even dabbling in the somewhat risky high yield or junk bonds. They play the field looking for opportunities wherever they can find them. To do this, they move assets around based on a few things: what's happening in the market, what things are worth, and what they think the future holds. What it boils down to is that the fund is concentrating on mortgage-related assets. To make things official, they're also letting us know their 80% policy. This means that they're committed to investing at least 80% of their money in debt instruments. They also have the option to invest a smaller part of the fund, up to 20% of its assets, into common stock and other investment companies. But when they are picking specific companies to invest in, they rely more on their own research rather than just listening to rating agencies. This will be especially useful when they invest in high-yield bonds, which can be particularly hard to value. The fund also focuses on duration, that is, how sensitive the fund is to interest rate changes, and they usually keep the average between 0 to 8 years. All in all, it sounds like a solid plan, but with all these moving parts, it is important to know the costs. Right, let's talk expenses. Expense ratios can eat into your return, so it's important to know what you're paying. For the institutional class, you're looking at 6.1. AR1 and 2 are slightly higher at 6.68%, and classes A3 and A4 are the priciest at 6.93%. The fund's management fee is 1.75%. Remember that the fund gets to utilize leverage, which comes at a cost. The interest payments on borrowed funds are at 4.422%. So how did the fund actually perform? Let's check out the financial highlights. Looking at the institutional class for the year ended June 30, 2024, the total return was a positive 13.85%. Not bad, but looking back a few years, it's been a bit of a roller coaster. Back in 2020, the total return was actually negative almost 10%. That shows you how much things can change. A big thing to notice is that the expenses are pretty high. For example, for the institutional class, the expense ratio has averaged over 5% for the last 5 years. Now for the not so fun part, the risks, and oh boy are there a few. Market risk is first on the list and pretty self-explanatory. The value of their investments can go up or down, sometimes quickly, but it's not just the overall market they have to worry about. Asset allocation risk, that's just a fancy way of saying they might make the wrong calls about where to put your money. There is repurchase offers risk. Since this is an interval fund, they offer to buy back a portion of your shares, but they might not always be able to buy back all that you want to sell, and they might need to sell some holdings at a bad time to make those repurchases. Something to look out for is a large shareholder risk. If too many shares are held by a small group of investors, it could mess with the fund's stability if they all decide to sell at once. Interest rate risk is another one. If interest rates rise, the value of the fixed income securities in the fund will likely fall. Then there is high yield securities risk, or junk bonds. These are risky investments that could go south quickly if the economy takes a hit. Because they invest in foreign countries, there is also foreign investment risk. Politics, economics, and even just the different rules in other countries can make things unpredictable. And of course, there is emerging markets risk. Investing in developing countries can be especially dicey due to their unstable nature. To boost returns, the fund uses leveraging, which is borrowing money to invest. But when leverage is used, the net asset value of the common shares and the yield to common shareholders will be more volatile. And as they say here, all costs and expenses relating to the issuance and ongoing maintenance of the preferred shares will be borne by the common shareholders, and these costs and expenses may be significant. This next point is also interesting. The fund also may borrow money in order to repurchase its shares or as a temporary measure for extraordinary or emergency purposes. So who is steering the ship? The investment manager for the fund is PIMCO. The key guys you want to be aware of are Daniel Ivassin, Alfred Murata, Jamie Weinstein, and now also Jason Steiner, Josh Anderson, and Russell Ganaway. They are the portfolio managers responsible for the overall investment portfolio. It's good to have a list of names just in case you want to dig deeper into their track records and how they think. Now let's talk about the money PIMCO gets for managing the fund. They get a management fee of 1.75% of the fund's average daily net assets. For the fiscal year that ended in June of 2024, PIMCO took home a cool $60.8 million. The investment management agreement allows PIMCO to provide all sorts of different services to the fund, such as investment management, administrative services, coordination, marketing, and a lot more. The investment manager could have potential conflict of interest that they must take steps to mitigate as part of their duty to the shareholders. Finally, the fund offers 5 separate classes of common shares: institutional class, Class A1, Class A2, Class A3, and Class A4. The fund's amended and restated agreement and declaration of trust includes provisions that could limit the ability of other entities or persons to acquire control of the fund or to convert the fund to open-end status. If you thought you would be able to nominate people you know to the fund, there are pretty strict requirements to do so. Make sure to read this part if it is important for you. Now, looking at these changes broadly, PIMCO seems to be adjusting its course in a pretty volatile market. The increased focus on specific areas in the global market suggests a strategic retreat to their core strengths, but high fees remain a thing to watch. Ultimately, this report underscores the need for investors to stay informed, diversify, and think carefully about what they are investing in. And that's so. Is the PIMCO Flexible Credit Income Fund right for you? Well, that depends on your risk tolerance, your investment goals, and whether you feel comfortable with the higher fees. Thanks for watching. If you enjoyed, please subscribe, like and comment.